Hello, today we are going to solve Jan 2025 question number 6. The LIFO inventory valuation part 1 is solved. Then now calculate the total purchases of the fuel for the 6 months ended 31st December 2024. So we have already had written here. Okay, so these values we have to just add up. So we have to add 4,000. Okay, 4,000 at here, 110. Okay, then you have 10,000 at 130. So plus 10,000 at 130. So the total purchases is, you have to add all this. Then we have made 7,000 at 1.50. And then you have 5,000 at 160. And then you have 4,000 at 1.80. And then you have 3,000 at 2. So let's see how many. So 4,000, 10,000, 7,000, 5,000, 4,000 and 3,000 at 2. So let's add up these values. Okay, let's calculate and add up these values. So if you multiply 4,000 into 1.10, it is 4,400. 4,400 plus 10,000 at 130. 10,000 times 130, it will be equal to 13,000 plus 7,000 times 1.50. Okay, that will be equal to 10,500 plus 5,000 times 160. Okay, 5,000 times 160, that will be equal to 8,000 plus you have 4,000 times 180. So if you do that, you will get 7,200 plus 3,000 into 2, that is equal to 6,000. So let's add up all of this. So 4,400 plus 13,000 plus 10,500 plus 8,000 plus 7,200 plus 6,000. So that is equal to 49,100 pounds. So that was the total cost of purchases. Total sales of the fuel for 6 months ended 31st December 2024. So for that, let's just calculate all of this, write this and just add up all of this. Okay, so it will be 5,000 at this thing. Okay, 5,000 at 140, and so the total sales will be equal to, sales is equal to 5,000 into 140, that will be equal to 7,000. Okay, 7,000 plus 8,000 times 150. Okay, that is equal to 12,000 plus 6,000 into 1.8, that is equal to 10,800 plus 6,000 times 2, that is equal to 12,000 plus 3000 into 2.20, that is equal to 6600 plus 2000 times 2.4, that is 4800. So when you add up all of this, the total sales becomes 53,200 pounds. So that's the total sales. That is equal to 53 pounds. Okay. Next, prepare the trading account of cocoa for the 6 months ended 31st December 2024. So let's prepare the trading account. So the revenue is going to be equal to 53,200 pounds, which we calculated 53,200. Then we have the cost of sales. So the cost of sales is going to be the opening inventory plus purchases. Okay, so opening inventory plus purchases minus the closing inventory. So the closing inventory value we had calculated. Okay. The opening inventory was 5,000 pounds. Okay. So the opening inventory was 5,000. Purchases. Okay. The total purchase cost was 49,100. So 49,100. And then the value of the closing inventory was 10,400. So less closing inventory, so 400. So the cost of sales is going to be equal to 5,000 plus 49,000 minus 10,400, that is equal to 43,700. So that is 43,700. So the gross profit, okay, for the year will be equal to gross profit will be equal to revenue minus the cost of sales. So 53,200 minus 43,700, that is 9,500. So this is the trading section for the Caca account. Okay, for the Caca trading account. Okay. Then we have explain the terms net realizable value. So net realizable value is the amount. Explain the terms net realizable value, NRV. NRV is the amount by which the estimated selling price of asset is going to exceed any additional cost expected to incur during the sale of asset, which means selling price minus any additional cost which occur during the sale of the asset. Then so this is going to prevent any inflated values of the inventory that could mislead the stakeholders and lead to poor business conditions. So any additional inventory costs you had to subtract and you had to find the from the selling price. Okay, so that is called as NRV. So then periodic valuation. Periodic inventory, it is a system of inventory valuation where the inventories are not updated in the accounting records after each sale or purchase as we did for perpetual inventory. Here it is updated only at the end of the accounting period directly in the income statement. Then inventory rotation, it means the physical movement of inventory which is being received and issued from the stores. So in general, oldest inventory is issued to avoid any deterioration and obsolescence. Then evaluate the suggestion of changing the method of inventory valuation to first in first out FIFO. So Kaka has been using LIFO method of inventory valuation, last in first out method. So what happens if they change it to FIFO? Now let's understand if they are going to change it to FIFO. Okay, it is going to reflect the accurate valuation because I'm going to sell off the older inventory first, so I know I have to sell off the older inventory. Higher gross profit in times of, for example, in during inflation. Okay, during inflation, FIFO is going to result in lower cost of sales, right? So leading to higher gross profit. So that's going to happen, which means okay, that's I'll get a higher, which is good for the business. So it reflects. So stakeholders will be happy. Stakeholders will be happy. Okay, when they see higher gross profit margin, okay, they will be happy to invest in the business. Now inventory valuation will match the market prices. So closing inventory is valued using the most recent purchase prices, making it close to the market value, and so it is easier to apply in practice. Okay, so then points for LIFO. In LIFO we see there will be no distortion, okay, during inflation, which means that you are accurately saying you're not overstating the profit, and also it is close to the replacement cost, and also you will not incur any high tax if there is a high gross profit, but in case of LIFO you will have a low gross profit and low tax. Then the product or the sales will not be overpriced in the current market conditions, okay, even if the because making it easier to plan for the future purposes. So in conclusion, Kaka can still use LIFO as an inventory method, and because it's a non-perishable good, she is selling some fuel, and so that she can comply with